Tesla is possibly the most well-known car manufacturer in the world. It's also one of the most successful stocks in recent memory, and its meteoric rise has made Elon Musk the richest man in the world. The question we're going to dig into today, though, isn't about whether Elon is going to cause Doge to rocket again this week, but rather to try and understand if the company can still reward shareholders, or if it's completely overpriced. Let's dive into it and try to understand the business units of Tesla and how they make their money. Tesla's primary business unit is manufacturing and selling cars. Tesla was an early mover in the electric vehicle space and is now the most well-known producer of electric vehicles in the world. Tesla has built a strong brand around its cars, and they're widely viewed as premium vehicles. Tesla currently generates the majority of its revenue from this component of the business. The main differentiator for this business unit is the gross margin of 30%. For comparison, the gross profit margins of Ford, Volkswagen, and General Motors are all well below 20%. This incredibly high margin is achieved through two primary factors. Number one, manufacturing efficiencies generated from their automation-heavy build-for-scale plants and factories, also some of the gigafactories. Two, the pricing power that being a luxury product allows for. As a point of comparison, Ferrari has a gross profit margin up to close to 50%. As this business unit continues to manufacture and sell more vehicles, it's likely we'll continue to see this profit margin expand. This is due to the cost efficiencies around manufacturing more vehicles from the existing plants. This provides Tesla with optionality in how it handles competition at scale, as it has a superior ability to reduce the cost of its vehicles when compared to its peers. One of the key drivers for future profitability in the business is the software component of Tesla. Tesla is continuing to invest in and deliver on a number of software as a service, or SaaS, initiatives to improve the experience for its drivers. A number of these premium services are relatively straightforward and allow Tesla to easily monetize its existing user base. This continued cash flow from existing Tesla owners reduces Tesla's exposure to the cyclic nature of car purchases that have been known to cause other manufacturers to have incredibly inconsistent earnings. The most ambitious feature relates to self-driving software. Tesla's existing autonomous driving feature provides a premium product the company is able to sell to its user base and roll out at scale. This business unit, in my opinion, represents Tesla's biggest long-term advantage over traditional automotive companies. However, vehicle software, particularly autonomous driving, is a highly competitive industry, and at this stage it's unclear if Tesla has a leadership position. Tesla has ambitions to become a major player in the energy space, in particular producing solar panels and batteries for both residential and industrial use cases. Having said that, the long-term direction of this business unit is somewhat unclear. The following is a clip from Elon during the 2021 Tesla annual general meeting that highlights the lack of near-term clarity in this business unit.
Quarterly update on energy along with automotive. We need to make more progress on energy. This year has been limited. Like I said, the chip shortage, the same chips go into our stationary battery packs as in the cars, and we prioritize the cars. So, and we need the inverters for solar and that kind of thing. So, this year has not been a good guide for progress in energy. I think next year it will be probably a good guide, and we can start providing updates that I think people would interpret correctly, as opposed to, having to explain, well, we either had to short cars or energy, and we picked cars. So, all right.
Tesla has recently mentioned it will be looking to get into the automotive insurance space. As stated in the company's third quarter update, Tesla actively monitor braking, turning, tailgating, forward collision warnings, and forced autopilot disengagements in order to predict the probability of a collision. This pivot into insurance seems logical, as it will have incredibly accurate data about its drivers that can be leveraged to build their statistical models. This service-style vertical is similar to what Apple's done with Apple Care Plus, and will likely help provide Tesla with a reliable recurring revenue.
Tell them to bring me my money.
Tesla's earnings per share for the last 4 quarters are 24 cents for Q4 2020, 39 cents for Q1 21, $1.02 for Q2 21, and $1.44 for Q3 21. This gives Tesla a trailing yearly earnings per share of $3.09. For the previous 2 quarters, Tesla has managed to massively surpass earnings expectations. This can be seen on this graph where the light blue bars represent Tesla's actual earnings and the dark blue bars represent what the analysts expected earnings to be. On the back of the Q3 results, the market capitalization for Tesla surpassed $1 trillion. This showcases the strong positive sentiment caused by Tesla outperforming expectations. Looking at Tesla's third quarter earnings report, we can see that Tesla's grown its revenue in the automotive segment by 58% year on year, while increasing its generally accepted accounting principles, or GAAP, net income by an eye-watering 389%. This massive earnings increase is likely due to the business gaining operating leverage. This is shown by the operating costs only increasing by 32%. Tesla has a strong balance sheet with more overall equity than debt. This is a major positive as it allows Tesla to reinvest more of its free cash flow back into business operations, such as building more gigafactories. This will help drive continued growth. Having said this, the balance sheet can be somewhat misleading in certain cases, as not all forms of equity are equally useful. For instance, Tesla has $17.2 billion in properties and equipment. However, that $17 billion is not liquid and may be hard to access in the event that money is urgently required. As such, I've created a simplified breakdown of current liabilities against current semi-liquid assets. Based on these figures, we can see that Tesla's cash and cash equivalents, combined with its accounts receivable and discounted inventory, more than cover the company's current liabilities, with a $3.6 billion surplus. This would indicate that Tesla's financial position in the near term is very stable. However, there are 2 points worth noting as potential risks. 1. The balance sheet does not make it clear if Bitcoin and other cryptocurrencies are being treated as cash or cash equivalents. As such, this position may be worth significantly more or significantly less depending on fluctuations in those currencies. 2. The balance sheet used for this analysis was unaudited and may contain some inaccuracies. In this graphic, we can see the debt-to-equity ratio of Tesla compared with some of the other players in the automotive industry. Tesla is the only company of those listed with more equity in the business than debt. Tesla's strong balance sheet is a major competitive advantage relative to its peers in the automotive industry, as it allows them to concentrate free cash flow on growing their business rather than paying down debt. This also puts Tesla in a strong position to take on additional debt if required to fuel rapid expansion. This, in combination with strong profit margins, forms a strong part of the economic moat around Tesla. In combination with their existing first-mover advantage, Tesla is in a strong position to protect its market share in the EV space from legacy car manufacturers. The most important question to answer for any company, in my opinion, is understanding what it's worth. I already have to overpay for beer anytime I go to the pub. I can't afford to be overpaying for stocks. The current share price for Tesla at the time of recording has been floating between $950 and $1,100. The consensus analyst estimate for the share price in 12 months is $880, which is below the current trading range. These price targets are generated from average values of many separate analysts and aren't always accurate, but let's try to dig into if this is a fair valuation for Tesla. Looking at the Nasdaq website, we can see analyst consensus earnings forecasts for Tesla. These estimates are generated from a very small sample size, but they do give us some data that we can try to model. I'm now going to attempt a pro-gamer move and use what many believe to be the most powerful stock analysis tool in the world. I've attempted to plot the analyst values to some clean growth percentage numbers on a 5-year trajectory. This projection ends with Tesla earning around $16.51 in the year 2026. I then use a slight variation on the discounted future cash flows model to arrive at a valuation around $855. The 2 key variables in this equation are the discount rate and the stable state PE ratio. The discount rate represents the risk-free return I would expect to be able to get in this given time period. For this equation, I've set it to 3% due to how low the interest rates currently are. The stable state PE ratio represents the multiple of earnings I would expect to be assigned to this company at that period of time. The PE ratio of 60 used here is comparable to Amazon, and I believe it's reasonable given that Tesla will likely have many years of double-digit growth even after 2026. This would also represent a major compression of the PE ratio Tesla currently trades at, which is 300. Let's take a quick look at the math behind how I arrived at this value. First step, earlier in the video, we calculated the earnings per share for Tesla in the trailing 12-month period. We then took this number and modeled earnings growth for the future. Finally, we smashed our values into the snazzy formula which some dude invented and arrived at our valuation of $855. So now that we're all math PhDs, it's worth remembering that we made up most of the variables here, and as such, this formula is only truly helpful for modeling our thinking, but given our input variables are mostly made up, it's probably not going to be accurate. Another important thing to remember about Tesla is it's the market leader in a rapidly growing sector. According to Fortune Business Insights, the electric vehicle market will grow at 24% a year until 2028. In my mind, I'd expect there to be a day when the entire vehicle market will be electric vehicles. As such, I've fitted a longer-term model to Tesla to try and more accurately project what I think the company may be worth. This model stretches to 2036 and is an accurate reflection of how I expect Tesla to grow. Based on the current rapid top-line growth and margin expansion, I expect Tesla to be able to massively grow its bottom line in the near term due to the increases in car sales and the efficiencies that are found with scale. In the longer term, I expect Tesla to continue to grow strongly, fueled by the long-term trend toward electric vehicles and the high-margin vehicle software business. This model does not account for any major successes in their insurance business or energy business, as based on the limited information available, those businesses appear far more complicated to project. I've assigned a discount rate of 10%, which is the average annual return I expect to be available to me over that period by investing in an S&P 500 ETF, and the PE ratio is based on the current PE multiple for Apple. I feel this is a good point of comparison for Tesla, as they are both hardware manufacturing companies with strong brands that reduce their exposure to hardware sales cycles through high-margin SaaS offerings. Tesla, in my opinion, is the highest quality car manufacturing business on the market. It solved the traditional problems of car manufacturing companies and is more of an evergreen technology company than a traditional cyclic car manufacturer. I'll be looking to pick up some shares if the stock dips below $800, as I feel that price point offers significant long-term upside, but at the current valuation, I believe there are more compelling opportunities available to me. Make sure you subscribe and press the notification bell so next week you can see my analysis of a company that I believe is significantly undervalued and I'm planning to buy with my next paycheck.